Yo, what's up, guys? Welcome back to another Wise Wealth. I forgot what we did the last video, but this video is gonna be very important. That we're gonna be going over inflation in this video. Yeah, I forgot what the last video was, but this this definitely connects. So, what exactly is inflation? Well, it's a gradual loss of your purchasing power over time, right? So, as time goes on, your money is gonna be less valuable, right? Essentially, that's what inflation is. The price of goods raises, and your money is not keeping up with that. So it's a large rise in the price of goods. A higher inflation means that prices are increasing quickly. A lower inflation means that prices are still increasing, but just not as fast. They're both inflation now. Now, there's three types of inflation that we need to know. One is demand pull inflation, two, cost push inflation, and the final one, built-in inflation. Now, we'll go over these later in the presentation. Inflation can be good though, right? It's a common misconception that inflation is horrible, price of goods going up, everything's so expensive. However, if you own assets, a high inflation is good, right? Because if the price of goods is going up, so is the price of your assets. Now I can calculate inflation by getting the average price increase in the basket of goods over 1 year. But how is inflation actually affected? Well, the main cause is an increase in the money supply, right? It, money supply can be increased in multiple ways. You can, print new cash, give money away, devalue money, loan out money. And what does this do? Well, if we think about supply and demand, as more money circulated, what does that do? It decreases the value of money. So money is going to have less purchasing power, right? That's essentially what it is. Inflation can also be caused by bottlenecks in supply and shortages of key goods. So, like we just said, supply and demand. So as there's a short supply, what happens when the supply is low? The price of the goods is going to go up, right? Because there's a low supply. Now, low supply, like we just said, equals a high price. And I'll make another video. I realize I should have probably made this video first, but I'll make another video on supply and demand. But anyways, a high inflation, workers are going to demand higher wages. And why are they going to demand higher wages? Because they need to keep up with the price of goods. And when the workers demand higher wages, what do the businesses need to do? Well, in order to keep up with that, they're going to be making more money to pay the workers. And when the businesses need to make more money, how do they make more money? Obviously, they're going to raise up the price of goods. So it's just a big cycle that keeps continuing and continuing. Now, there's three types of inflation, as we went over. We have the demand pull inflation, which is when demand for goods exceeds production capacity. So you could basically, in simple terms, this is just when demand is greater than supply. So when demand is greater than supply, that means there's a low supply. And what does that mean? Since demand is pulling ahead of the supply is going to have to, the price of goods is going to increase, right? Because there's a lower supply than demand. If we look on a supply and demand chart, which I'll put on the supply and demand video, you can see that. Now we also have cost push inflation, which is when production costs increase prices. So, for example, an increase in the money supply will create a speculative boom in oil prices, and in return, the gas price may rise, right? And the last type is built-in inflation, which is when prices rise and wages rise. Now, how can you protect your money against inflation? Well, first thing is invest in assets that are known to outperform the market. So maybe you can invest in some real estate. You can invest in some growth stocks. You can maybe invest in some options, whatever you want. The second thing you can invest in is commodities. For best example here is gold, right? Obviously, we know that gold is a safe haven asset, and gold is pretty stable as in investment terms. It's pretty stable. Sorry, my nose just like wrote issue for some reason, but gold is probably the best example here because it's an international commodity, and everyone gold definitely has value, so it's just gonna go up. Um, Real estate income, such as maybe your rent, the value of your property increasing, etc. Or you could buy treasury protected securities from the government. Guys, I don't know why my nose is so itchy. Please forgive me. Anyways, what are some pros and cons of inflation? Well, it's not all bad, right? The pros, obviously, we said if you own assets, the value of the assets is going to go up, which is good for the asset holder, right? And optimal levels of inflation also encourage spending, which increase the economy, which grow the economy rather. Cons, well, consumers are going to have to pay more for goods, so that's not good. higher prices on the economy. Prices vary as to when they're driven up. So some prices might increase now, while other prices might increase later. And how is this controlled? Well, the government uses, or the central bank uses monetary policy, which essentially controls the supply of money and how money is circulated. Now, either the Fed will raise or lower the interest rates to encourage and discourage spending. So, for example, lower interest rate. If you have a loan and the interest rate is 2% versus a loan that's 10%, which one are you more inclined to spend money? The 2% loan, right? Because they're spending less. So lower interest rate encourages spending, and more spending means more money into the circulation, and more money into the circulation means a higher inflation rate. So what's the Fed going to do to combat this high inflation rate? They're going to increase interest rates to discourage spending, right? To make people spend less. And the opposite, we have a higher interest rate, right? People are not going to want to spend as much money, which is going to lead to lower inflation, which is going to lead to less economic growth. And what's the Fed going to do? Decrease interest rates to encourage spending. Now, the Fed also uses a thing called quantitative easing, which is where the Fed buys bonds in the open market, which is known as open market operations. And essentially, this increases the money supply and reduces interest rates. Why? Because it injects bank reserves into the economy and provides more liquidity. Now, if you guys want another video on quantitative easing, DM me or leave a comment, and I will make a video on quantitative easing. It's a little bit more complicated than this, but this is just the simplicity of it. If you guys want another video on quantitative easing, I'll make another one. Just leave a comment or DM me, and I'll make another video to provide more clarity. But in addition to this, the Fed can also sell bonds, right, to do the opposite. Now, we have deflation, disinflation, and stagflation. What are these? Well, deflation is where the inflation rate becomes negative, which means that prices are falling. Now, if inflation rate is positive, which means the price of goods is going up, deflation means the price of goods are going down. It's very self-explanatory. And the buying power increases. Now, you might say this is a good thing, but people are not going to want to spend as much money, right? And it's going to cause a decrease in economic activity. Now, disinflation is not the same thing as deflation. It's where the inflation rate is falling, but it's still positive. So there's still inflation, but it's just going down. Stagflation is the worst out of the three. This is a combination of slow economic growth, high unemployment, and a high inflation rate. Now, these three things combined are very bad. Obviously, we don't want slow economic growth. Obviously, we don't want high unemployment, and obviously, we don't want a high inflation rate. So these three things must be avoided. And how does the government do that? Well, we just explained it last slide. So essentially, this is the basics of inflation and how it works. Now, I realize I should have probably done the supply and demand video before this, but that's going to be a next video coming out, so stay tuned for that. But I hope you guys learned something from this inflation lesson. If you want me to make a separate video on anything, then either DM me or leave a comment. Or if you want just a video in general, just about something, leave a comment or DM me. And I hope you guys enjoyed this video. Stay tuned for the supply and demand video. It's very important.